I would like to start by, talking about what I call the 4 E's in relation to the, topic under discussion. You notice there are 2 explanatory variables here, the budget and election. And what is being explained, of course, is the performance of the market. Now, in relation to the budget, I want to focus on those 4 E's. The first is the expenditure itself. That's talking about the size, which the moderator, has, rightly mentioned. The size is just too small for this economy. If you even go back to literature or theories, you discover that some of the popular theories in public expenditure, take Adolf Wagner, for example. Adolf Wagner, talks about ensuring that your public expenditure, your budget, is always growing at a steady pace. Later theorists like Jack Weissman and Alan Peacock even said that the worst case in terms of public spending should be, retaining or maintaining the previous budget. So that expenditure is expected to move in a stepwise fashion. So even if when you maintain, there must be a reason to go up, to go higher. So the point I'm making is this, that whenever we're formulating budget, it's important we recognize this, that we don't have to reduce the amount we are spending relative to the previous year. This year 2019 is 8.8. Last year we had something higher. It has an information content. It has a signaling, the property. And that signaling property is not positive for the capital market. So as much as possible when we formulate budget, we should try to ensure holding exchange rate and inflation rates constant, that we maintain a steady rise in public spending. That brings me to the second E, which is the embodiment or the composition of the expenditure itself. He mentioned it. He talked about 1.8% of GDP representing capital spending. In the last 3 years or so, it is good that we have maintained a minimum of 30%, expenditure for capital. But again, of course, it's not just about capital spend, but it is the quality of that capital spend. In 2018, for example, if you do an analysis of what is put together as capital spend, you will discover that about 42% of that capital spend is non-developmental expenditure. When you spend 58% of your budget on furniture and fittings, of course, furniture and fittings is long-lived asset. It's grouped as capital expenditure. If you spend that on private motor cars, those are not developmental expenditure. Developmental expenditure is expenditure on roads, on schools, on hospitals, on railways that will impact the economy. And of course, we know those are positive for the capital market. So the quality of that capital expenditure is also important. The other issue I want to the other E is entry, or the content of even the budget itself. I gave an assignment. One of the assignments I usually give to my PhD students of finance, many of whom have bias for capital market, is to go and get for me the implications of the 2019 budget, or annual budget, on the capital market. Okay, looking at taking a minimum of 5 emerging and frontier countries. And what came in, it was evident that while some countries, recognize the fact that it's important to include pro-capital market measures in the budget, some others don't. And those that include pro-capital market measures in their budget, okay, had a correlation with the capital market growth. What are those pro-capital market measures? Pakistan, for example, is talking about reducing companies' income tax for companies that are listed on the stock exchange. India, for example, is talking about privatization, privatizing through the stock exchange. In 2018, we talked about raising 300 billion naira from privatization proceeds in Nigeria, but of course, nothing came in. If we must privatize, the way it can be impactful has to be through the stock market. So it's important when we are formulating budgets, okay, to ensure that we introduce pro-capital market measures in those budgets for us to have a direct impact. Dr. Uwaleke talked about indirect impact, because that's what we usually find, expecting that what we put in the budget will have an indirect impact, on the capital market, transmitting through maybe interest rates and inflation. But it's also important to recognize that the government can intervene directly in this market, but by including pro-capital market measures in the market. Finally, on the budget is on the execution, that's implementation. It's one thing to package a budget, it's also another to see to its implementation. The delays we've been having in budget passage, no doubt, have been impacting negatively, on this budget. If you look at what happened in 2018, for example, 2017, the market returned 42%, one of the best in the world. In 2018, in addition to the election anxieties, the delay in the passage of the budget also contributed to the dismal outing we had, particularly in the equity segment of the market, in 2018. So it's important that we return to the normal calendar year that is provided by Section 316 of the Constitution, which clearly says the budget year should run from January, to December. And because the lecture too touched on the investment, the road infrastructure investment and tax credit, that's Executive Order number 7. I also want to quickly mention that it's also important we get the government to enforce the Executive Order number 3 that talks about patronizing locally made products. Because again, that is something that will also impact positively on the capital market, especially if that patronage is, tweaked in favor of companies that are listed, on the stock market.